Hi everybody, welcome to Chapter 2 of Price Analysis, a fundamental approach to the study of commodity prices. This chapter deals primarily about the basics, about what's governing our thinking when we engage in price analysis, and some sort of basic definitional things related to price analysis and forecasting. So let's start with the first definition, get that over with right off the bat. What is a commodity? A commodity is something where the good is going to be fungible. You don't care whether you buy a bushel of corn here in Illinois or whether you buy a bushel of corn from South America. You know that the qualities related to that good should be more or less identical with some modest variation, no matter where you get it. Things that have the property like that are called commodities. And the thing about commodities, them being fungible, lends the global market for those goods to be interconnected. And it becomes an interesting question about how production problems or demand all over the world come together to form sort of one integrated price all over the globe. One of the most important concepts in commodity price analysis is how commodities undergo various transformations, particularly over space, time, and form. So commodities are generally consumed in very different locations than they are produced. And so there needs to be market incentives that will move corn from, say, central Illinois to hogs that are living in North Carolina. This transformation over space is usually facilitated by differences in the cash prices at different geographic locations. You can think about if the price of corn is, say, $1 cheaper in Illinois than it is in North Carolina, and then someone is going to have the incentive to put corn on a truck in Illinois and ship it out to North Carolina where the hogs can eat it. So it's that kind of spatial price differential that incentivizes commodities to move through space. Commodities also have to be coordinated so that their use can be spread out through time. We only harvest corn once a year in North America and once a year in South America. So all of that grain has to be stored and then brought out of storage at a reasonable pace and according to market needs. And the way that's typically coordinated is traders making their best guess about what future spot prices will look like. That manifests itself in a forward curve in the futures market, which we'll talk about in later chapters. And farmers can take a look at that forward curve and either hedge and lock in a return to storage, or just make a bet on the price staying favorable to them to store their grain instead of selling it into the system at the current time. Commodities also oftentimes have a transformation in form before they are used for their final purpose. For example, soybeans are not usually consumed in their whole state, but usually crushed into soybean meal and soybean oil, as we discussed. That allows soybean meal to be utilized as animal feed and soybean oil to be utilized for human consumption as an edible oil and other purposes. Price spreads also coordinate activity in this case. For example, you can consider the potential revenue gained from transforming a commodity like soybeans by watching the price of soybean meal and soybean oil relative to the cost of buying soybeans. And you know what kind of incentive soybean crushers have to ramp up production or to ease off on production. The most famous example is probably the crack spread, the process where refiners take in crude oil and then refine it into different products like gasoline and jet fuel and a variety of other things. In later chapters, we'll learn about all different kinds of spread in the soybean market, in the crude oil market, in the corn and ethanol market, in the livestock market, that incentivizes this transformation in form. One of the most important characteristics of a commodity is whether it's storable or non-storable, and this really impacts the way price analysis will proceed for these cases. Storable commodities are things like corn, soybeans, wheat, crude oil, things that you can put in a container and put it in there for a long time and have the quality of the product not degrade by very much. Other commodities are highly perishable. All of the livestocks are non-storable. Milk products are not very storable. Different kinds of fresh fruit and fresh vegetable products. And one prominent example is electricity. When we talked about transformation of a commodity through time before, we were essentially talking about storable commodities. The way we usually think about price analysis for a storable commodity is that prices can be discovered in, say, the nearby futures contract, and then storage arbitrage will govern the prices that appear along the forward curve. So we know what the general price level is by price discovery in the nearest contract trading, and then the price spreads between the nearby and the deferred futures contract have to incentivize farmers to keep some of the crop off of the market, or some of the storable commodity off the market. And if the incentive to store isn't high enough, then people will bring the product out of storage, and that'll depress the nearby price and make that return to storage look a little bit better. That effect can't really occur for non-storable commodities because there's no link between the product that exists today and the product that exists tomorrow. We have to produce a new product for the next time period. So that really impacts the way those forward curves look between storable commodities and non-storable commodities. There's a subtle distinction between commodity price analysis and commodity price forecasting. Price analysis is usually an activity where you're trying to understand what's going on with prices, and it has a little bit of a backward-looking component. Well, I guess I should say you're trying to understand what's recently happened with prices that will help you kind of know what to expect coming forward. It's a very subtle difference between price forecasting, which is just about trying to get the best estimate of what prices are going to do in the future. So the goals are similar. I mean, in both cases, you want to understand prices in order to make good decisions going forward. But price forecasting is pretty agnostic to the way it understands what has happened. It just tries to use it in the best way to make a prediction. If you read the popular press or any kind of publication that provides forecasts, you'll see forecasts presented in a variety of different formats. Sometimes you'll be presented a directional forecast where people will just tell you that whether they expect the price to go up or whether they expect the price to go down. The next kind that is often presented is a simple point forecast, so where someone says, I expect the price to be this amount at a certain date. So the example here on your screen is Fed steer prices for the first quarter of 2016 will be $150 per hundredweight. That's a point forecast because you're only given a single point. The next kind is an interval forecast where they might tell you a range, but no kind of sense of probability that the probability of where the price will fall within that range. So Fed steer prices for the first quarter of 2016 will be between $140 and $160 per hundredweight. The next level up from that is a confidence interval, where you're given a range and a percent confidence level. So you say something like, we're 80% confident that Fed steer prices for the first quarter will be between $140 to $160 per hundredweight. The next level of complexity, of course, is where you're given the entire probability distribution of the forecast price. And that's definitely the most specific and detailed information you can be provided, but it can also be the most hard to interpret. So you see the examples that we went through go from sort of simplest to interpret to more complex to interpret, but also more detailed in the information that they're giving you. The next concept in forecasting is the forecast horizon, and that's just the length of time between the date at which you make the forecast and the date of the price you're trying to predict. So if you're dealing with monthly data and you're coming up with a statistical forecast, a one-step ahead forecast would be a 1-month forecasting horizon, and you're going to be projecting prices of what prices will be 1 month from now. A 2-step ahead forecast would be 2 months from now, and an 8-step ahead forecast would be 8 months from now. If it was daily data, similarly, a 1-step ahead forecast would be 1 day from now, 2 steps ahead would be 2 days from now, and so on. This gets a little bit more complicated with the seasonally produced commodities like corn and soybeans, because we have to think about what we commonly call a marketing year. So the marketing year begins with a harvest, so we bring a bunch of corn out of the field and into storage, and then the marketing year goes all the way from that harvest date until the next harvest period. And so it's kind of trying to forecast what the prices are going to do as we're using up that year's crop. In forecasts, there's often value in following the principle of parsimony, in that if you have two competing models that perform similarly, you should probably choose the simpler one. And that's related to the fact that complicated models typically tend to overfit the data, and they might produce less reliable forecasts out of sample. And when you're trying to produce a price forecast, you kind of have to be aware of the historical context. So to drive this point home, I've got a picture here of the price of average prices received by farmers in the United States over a really long time trend, 1908 to 2015. And the data comes from the National Agricultural Statistics Service of the USDA. And I used that data and basically reproduced a plot that you'll find in the Farm Doc Daily article written by Scott Irwin and Daryl Good that's linked at the bottom of this chapter. And their point in this article was talking about how we've had a few periods of structural change in the United States in terms of the corn market. And when you're trying to make forecasts about what prices are going to do next, you have to think about whether or not the most recent time period where we've experienced historically high prices, whether that's a new normal or whether it's just a temporary blip and we'll be going back down to a longer term trend identified there by the middle red line. So first they identified some historical context, and they noted that since the beginning of the 1900s up until the beginning of the 1970s, corn prices seemed to be following a really flat trend line, and it would have temporary spikes up and temporary dips down, but did not seem to be following any trend up or down in general. And then at the beginning of the 1970s, the whole world seemed to change. And they identified that in the 1970s, we had a bunch of markets that went from being closed markets to being open markets, and so the opportunities to export U.S. grains became significantly more than they were before. And as we had access to new export markets, our prices just shifted up to a permanently higher long-run mean. The third period in the graph is 2007 to present, and it represents the time post-biofuels policy. So as soon as we started ramping up production of corn-based ethanol in the United States, we seem to be experiencing this permanent shift upward yet again in corn prices. And the Farm Doc Daily article that I mentioned was basically asking the question about whether is this a new normal or will we stabilize and have prices go down to that 1974 to 2006 level. It's hard to say at this point, even though we've had a couple more years under our belt. Corn prices are now trading around $3.50, which is kind of the bottom of the range of prices in that new time period. So it remains to be seen what will happen as we move forward and plateau in ethanol production and experience inevitably increasing corn yields. Be sure you take a look at these two excellent readings that provide some context about the chart I showed at the end of this chapter, and make sure you can easily answer the questions in the exercise section. That concludes what we have for Chapter 2. See you again in Chapter 3.